Hello and welcome back to another episode of Fun Friday. We're in the green room today. This is a new room in my house that has not been painted yet. So if you're watching this, please do not mind the color of the Lamborghini green that I'd like my car to be if I get a Lamborghini at some point. But that's neither here nor there. What is important today is my friend here, managing partner of Amity Cashflow, Chris Collins, joining the show today. How are you today, my friend?
I'm doing incredible. And it's funny that you mentioned Lamborghini because this sits on my office desk all the time. Lamborghini Reventon. Check that out. So
Yep.
I'm right there with you, man.
Awesome. Well, thank you so much for coming on. You're obviously really active in the passive investing space. You have really great, useful, and valuable content out there that I think is really great to absorb. Also, notice too that it's very aesthetically pleasing. So you've really hit that well. It's obviously piqued my interest. And then, of course, being in the syndication space, we both know how small it is. So it was only a matter of time before you were going to come on the platform here. So thank you so much for donating a time in your day before you get on the boat with the family out there in Southern California, but would love to kind of dive into your story, who you are, your background, what you look for, and things of that nature. So let's get right into it. What did you do before getting kind of into real estate? What's kind of your background that brought you to, the beautiful world of syndication that we're in together?
Man, I appreciate it, Craig. I have a bit of a different story than most people in this space, I find. I have a creative background. I come from the Hollywood entertainment industry in the television world. I came up as an editor, editing unscripted and reality TV and documentaries. I've edited shows like Shark Week for Discovery Channel, America's Next Top Model for a lot of years. I've done fashion shows for Amazon. Making the Band, Rob's Fantasy Factory, a bunch of fun shows over the years for MTV and Discovery Channel and History Channel. We created Ancient Aliens on History Channel if you like that kind of thing. I'm also a musician. I'm a drummer. I've toured this country many times in different bands ranging from death metal to pop punk and dance music. And I'm also a father. I have a wife and two kids, and that's a huge part of my life. And so, really, man, my journey into real estate, like the TV industry, you get paid pretty well, as you can imagine, like the Hollywood industry, everyone makes pretty good money. But I saw a really obvious trend of all my friends making good money, but then nobody kept their money. No one knew how to multiply their money. No one knew what to do because we were trained in finance. We were trained in creativity and telling stories and dealing with content and how to manipulate content. Money is just simply the paycheck at the end of the week, and then you go out and you buy your BMW, you buy your house, and before you know it, you're broke again. So I saw that pretty early on, and I've always been entrepreneurial and pretty financially savvy and pay attention to that side of the world. So I made a pretty strong decision to figure out some way to take that money and start multiplying it and start investing it not just in the stock market, but into something that would ultimately create long-term wealth for my family. Because the freelance world of television, it's freelance, it's you get paid each week, and if you don't work that week, you don't get paid. If there's no long-term health care, there's no pension, there's no retirement. It's a very different world than a lot of people live in, with their 9 to 5 and they have all these benefits. So I tried to find a fix for that, really. It was how do I save myself from that and save my family from that? So that was kind of that was the big deciding factor. It's like I got to figure out a way. And real estate didn't start as a huge idea. It was just simply, I understand the idea that if I buy property and someone pays rent every month, then I get a paycheck every month. And then if I spend all that money the next month, guess what happens again? Rents come in again. And I spend all that money. I was like, oh, there's this unending supply of money that keeps coming in as long as I can get into it and start buying it. So that was kind of the start, man. It was a wild transition because everyone in the TV world that heard what I was doing, it's such a left field thing to do. It's a switch completely. And so I built it from there, honestly. But that's the background before I got into real estate.
Well, it's very interesting, and I appreciate the detailed story there. And it's funny, being as someone who grew up in the reality era, being a 29-year-old, always watched MTV's The Challenge, always watched Viva La Bam, Jackass, Wild Boys, all those incredible and really impactful shows really great shows, great TV back in the day. So I missed that era of TV. RIP to that. But really cool. I did not know that about you. So thank you for sharing. But you mentioned something really interesting there, which was, kind of the money supply of apartments coming in, now having to labor it, having the dollars labor for you, which is super interesting. And I have to imagine, with a lot of your, investor avatars, people that are probably from your past life, and then referrals come in, but it might seem probably pretty foreign for some people to, and probably invest in apartments because, it seems almost out of reach. Like, oh, this big apartment complex, it's only for the uber rich, as they always thought. Hey, out of state investing. Well, what if, it's a scam? So have you been able to kind of overcome those objections? And what was kind of that process like on your end to kind of maybe eliminate limiting beliefs and express how, normal that process really is?
And that's a great question. And I'm sure you've seen it in a huge way because you guys are like, I look up to you guys. You're so successful and you've done so much in such a quick amount of time. And I know that your friends around you are similar to me and they're looking at you going, like, I've had these conversations where, my friends just came back from a weekend going to Palm Springs with their family, and I just got back from Texas. What were you doing in Texas? I was looking at some real estate we bought. Oh, did you guys buy a house? Oh, no, this was a 250 unit apartment complex. And you see their eyes just like boggle, right? Like, what are you talking about, Chris? And really, it was a lot for me to learn too, because I started by buying single family homes, and I was just going to buy single family home, and just stack them until I had enough income coming in. And the reality is that works, that is a good plan. It's a bit of a slower plan, than I was looking for. And I think it's hard to scale that in a big way. But I always tell people like any avenue of real estate should work as long as you stick to it and become excellent at it. And so I started down the path of houses. Then I learned about multifamily and syndication, and that groups of people can buy these apartments. They're not just owned by individuals who are uber wealthy that can just buy massive amounts of real estate. And I realized, like, oh, I like the idea initially of passively investing. I like the idea of partnering with an expert who does this as a job, as a career. And I like the idea of being a part of a big machine. To me, that makes a lot of sense. I feel like a house is a small machine with any one little thing that goes wrong can kind of break that machine. But when you're in a 200 unit apartment complex, one little thing breaks, it's hard to, this machine is moving, right? Like there is a lot of operating pieces in there, full-time management, maintenance staff, a lender that's looking at it on a daily basis, operators with teams of people. So I like the idea of being a part of that. But yeah, it took me a few years of dedicated learning before I even put money in any of it, just to learn the business plan. And that's, I think, the big difference that people ask me about, people talk to me about, people have me on stage and talk about is I did it for myself with my own money before I ever thought to talk to investors and to work with other people and their money. So when people ask me questions about it, it comes from my personal experience. This is what I did. This is where I made money and lost money. These are the mistakes I made. These are the things I did to win. And so I'm not giving people book knowledge necessarily. I'm not spouting theories at people. I'm spouting, hey, this is what we did on this property in San Antonio. This is what we did on this property in Jacksonville, Florida. And so people like that, and I think it it makes it feel more real to them, that when I'm describing or giving them an answer to something, it's not so heady and it's not so otherworldly to them because they can tell that they're just talking to one of their peers that somehow managed to do this. So if we can communicate and they can ask their question, then I can just tell them what I would do in their shoes. So it has been a learning experience to get from zero to large multifamily properties. And, I think the investors appreciate that I can kind of relate to them on that level.
Without a doubt. And you mentioned something that I really know from firsthand. I used to think, because I was a residential real estate agent prior to working with Lone Star Capital, I used to think I want to own 10, 20 homes, and you do this, you do that. And I do think homes offer incredible appreciation, but the cash flow is a little bit less, especially And it's funny, especially as markets get more mature, your cash flow is going to go down. So you're gonna have to put more cash on the table as an investor to do it. You're gonna have to figure out the debt. You're gonna have to figure out a management service if it's not locally owned, so you can't do it yourself. But then you hit something so crucial. What if you buy a house and then 2 years into the house, the roof goes out, the AC goes out, depending on where you are, the plumbing gets messed up. Well, if you had, razor thin cash flow margins, which typically speaking, these properties do have razor thin cash flow margins, now you might get a big back end exit. You're gonna to completely destroy your free operating cash flow by fixing one little capex, expenditure, as opposed to multifamily apartment complexes. You're so right. It is a well-oiled machine. It's anticipated things are going to come up. And since you have so many different revenue sources to pay these bills and the expenses, your economies of scale are going to be better. The repair is going to go better because you're probably having someone on tight fix on property fixing those issues. So it is such a more creative and better cash flow solution to fix, juxtaposed to the single family space, which I'm sure you probably learned yourself from starting there, of course.
Yeah, and it's one thing I've been really impressed looking at your guys' offerings at Lone Star. Like you guys factor all those elements in, right? It's like you said, it's a well-oiled machine, but the business never feels well-oiled because there's always things coming at you. There's always things coming at you. There's always new updates, new things you didn't expect. But the best you can do is to prepare for as many of them as you can using the experience that you guys have already done by buying multiple properties and dealing with those issues. So those issues, they don't scare you anymore. They're just like, oh, that came up. Okay, here's how we're going to address it. Do we have money set aside for it? Yeah, in our reserve budget or in our CapEx budget. Or we knew that something was going to happen in electrical. We just didn't know exactly what. So you know, it it does feel like there's always something going on, you know, and so especially when you're buying value add properties like what we buy. But I do like that you can prepare for them and that it's not one person because it's also just the stress of it, right? When you have a house and you get a phone call and you're trying to figure out how to fix the stove because there's one tenant that's calling you, it takes your whole attention away. But when you know your management company is already set up and they're just looking for you for your weekly reports and they know that the maintenance guy is going to go take care of it because it's just unit number 7, then it feels a lot more like it's just part of the game. This is just part of the business as usual. So you're absolutely right.
Well, and the key thing to think about there, and I love that, and that's the thought process, and it's the concept of mind share. If something is taking up a disproportionate amount of your mind share, if something is, really taking you away from what you should be doing, if you're a passive investor and you're looking to invest in houses, you probably aren't going to be that passive depending on the property type, right? Like certainly can get there, but having mind share and something taking away if you don't have your systems dialed up is honestly really tough. And if you're looking to diversify, get into real estate and whatnot, you probably want a situation where it's really more like a stock, and you have a financial advisor, someone like myself or you're the person, the fiduciary in the situation, calling you to update you what's going on, not to have you fix anything, but just for a quick touch in here and there. We have monthly reporting, which does a lot of the legwork for us there. But for that to kind of come in and for you to take care of that, all the mind share is gone. Maybe there's a call we have to make if a distribution gets paused, or if there was a bad weather report, or hey, we're about to sell, or hey, we just closed the property. That's fine. But you want the process to be as streamlined as possible without having any more friction in your day to day. Because I don't know if you feel this way, but it seems like everyone is busier than ever. And mind share is really just something that I think about anytime I get into something is how is this going to take away from my mind share? And I'm sure that's something you experience with your investors as well.
Yeah, absolutely. I mean, as a passive investor, these people are not professional landlords. They're not looking to be professional landlords. They're looking to spend the time with their families on the weekends going to the beach. They're looking to spend their time focused on their job and their trajectory in their career, right? How do they get to the next level in their career as an engineer or a TV editor or a producer or a doctor? Like they don't want to shift their whole focus every day to thinking about real estate. And so for them, it really allows them to be a part of I mean, such a great investment opportunity, right? I mean, it's tough to argue that multifamily, I focus on multifamily investing. It's hard to argue that the returns aren't there and that the stability and I mean, just as a diversification play, I mean, if you're trying to assess risk, there's certainly higher risk opportunities out there. There's lower risk opportunities. I think multifamily is right in the middle. It's a great way to have your money multiply. But to your point, it's like it's a lot for your typical 9 to 5 worker with a family to somehow focus on real estate at a professional level. And I think that's where a lot of investors go wrong. They try out real estate, they try it, they're going to tinker with it, they're going to see how it goes. And I've had plenty of experiences where friends tell me, they hear that I invest in real estate and they say something like, "Oh, I just bought a house. It's a rental property." I'm like, "Great, man. Good for you. Congrats. How are the numbers?" And they kind of have this look on their face like, "The numbers, what do you mean?" And I'm like, "Well, how's everything look on it?" And they're like, "Well, I almost covered the mortgage with the rent, so that's good." Oh, okay, cool. What about you got reserves set aside, you got your insurance, you got, CapEx budget, you got any of those things set aside?" And all of a sudden their face kind of glazes over, like, I'm like, "Okay, cool. That's fine. That's good for you." There's plenty of people that hopefully they'll win. I hope for the best for them, but it doesn't feel like a plan to me. It feels like a wish, and I hope that it's going to work. And I don't operate that way with my money. I operate very planned out, business like. I want to assess risks. I want to learn and grow and constantly pay attention to it because I feel like what you pay attention to grows. And I'm trying to make more money for myself, my family, and for our investors. So, yeah, if you're not going to devote a lot of time to becoming professional and great at something, why not invest with people like you and me who are doing this on a daily basis and treat it with that type of respect?
Without a doubt, and you're taking the guesswork out of the equation. And I think often another thing that I think really does kind of miss the mark from time to time is when you work with professionals, not hobbyists. And that's really what the crux of the matter is. It's professionals, people who are doing this all day are hobbyists, right? And that's fine if you want to be a hobbyist. There's a lot of people that their retirement job might just be becoming a landlord. Like I want to retire to become a landlord. When I'm 60 years old and hanging out and I get to go to Newport Beach with my family, I hope, hey, a sink went out and I have, XYZ manager to fix that. Or, it'll probably be mostly in funds and passive just because it's easier to manage that. And I just get, the mailbox money, right? But I think about that all the time. So a lot of your points are really landing well for me. And with that said, let's talk about your first real estate investment. Was that from a single family home? It sounds like potentially.
Yeah, I thought I was going to do turnkey housing. Like that was kind of a thing. It's like buy a turnkey home, someone else sets everything up for you, and you just buy it, and there's already a renter in place. So I started with that. We bought a couple of houses in Memphis, Tennessee, and I learned a lot through that. I mean, this is part of a new development, so the house is brand new. Nothing was going to go wrong. Nothing was going to break. But then I quickly learned that when you're part of a new development, the downside is that there's a whole development around you of new houses coming online. So I got to learn about absorption, which we talk about in multifamily, but not in the single family space. You
Yeah.
just talk about, how much you're going to rent it for. But it's the idea of like how many houses are available and how many renters need a house in that moment of time. So I had multiple houses sitting there, not rented, brand new, ready to be rented. They look shiny. They should rent, but now I'm waiting for someone to pick my house to rent versus the house down the street that looks very similar, but it's also brand new. It's just available. So are they going to pick my house? Are they not? And then I got to experience the joys of having property managers that most people think. It's funny when you haven't invested in real estate, you think, well, I have a property manager and they deal with everything. And that's the theory, but then you can tell the people who have gone through the process because what actually happens is your property managers either calling you to ask you for clarification and ideas and how much money you want to spend on fixes that have to happen at the house. Or on the flip side, you are looking at your financials, calling the property manager, nitpicking, questioning every single line item because this shouldn't cost this much and this shouldn't cost this much. And I went through all of that. So it's a really, you can tell like the people who have gone through these battles because there's this moment of realization when you're like your property manager calls you all the time, huh? And they go, "Yeah, like I don't want, it's not what I wanted, right? I didn't want that from
I
my
didn't sign
property
up for this. I
manager."
didn't order that. Yeah.
Yeah, exactly. So it's a great way to, property managers are great sometimes. Other times it's a great way to spend a lot more money than you had planned to. So that's how I started. And I thought I was just going to do that, but eventually ended up pivoting into multifamily, a lot of based on people that I met. I spent a lot of my time networking and meeting other professionals in the industry, especially as I was transitioning from television into real estate. Man, I spent every waking minute, if I wasn't editing Specifically, I was at a real estate event. I was meeting someone for coffee. I was on a phone with people like lenders or brokers, just getting to know the business, know the lingo, or I was reading books or listening to podcasts. So I spent a lot of time meeting people and I learned about apartments. And that's when I transitioned to apartments.
That's awesome. So what was the catalyst that brought you over? I guess what piece of information out there specifically to apartments? Obviously, you had your kind of tired landlord story, and you kind of learned quickly the lack of scalability and the potential downsides to home, which are the pros and cons, of course. But what was the kind of linchpin to put you over the top to get you into apartments?
Well, two things. One, I was driving around with a realtor talking about how I was trying to get to $20,000 a month of rental income. And the realtor had been telling me how he has all these rental houses. This whole time he's kind of, bragging or sharing that he's being successful in this. And I shared that I'm trying to get to 20 grand a month. And he goes, "Oh yeah, like I hope to get there too. Like me too." I'm like, "How many houses do you have?" And he said, I think he said like 43. I'm like, "Man, 43 houses and you're not there yet. That's a lot of transactions, a lot of down payments, a lot of loans, a lot of figuring out how to get loans. Man, there's got
A
to be
lot
a
of
different
headaches
way."
too. 43 single
43
units,
individual
not a
houses.
43 unit property, but single units that my guess is that these properties are not on the same street either. If it's in a metropolitan area, it's
Yeah.
probably scattered if they're even in the same area.
Yeah. And so I had a couple of great conversations with, people who have been kind of mentors to me in my life, other multifamily syndicators, people I've partnered with now and invested with along the way, and just had a couple of, come to Jesus moments where I tell them, here's what I have, here's what my financials, here's what my houses are doing. And they're like, "Well, I'm doing apartments and this is how those are going. And I think you could get to your goals a lot faster if you looked into apartment syndication." So it was kind of as simple as that. Like, here's another option. And then I pivoted and started focusing on that. So um, that conversation was very sobering, though.
Yeah, well, the great thing is that you learned and you adapted and you made a quick choice and transition, which is great.
Yeah.
And speaking of transitions, you obviously raise money for deals, right? And I believe from this conversation, it sounds like you could probably only raise for apartment complexes. Do you do anything outside of that from an alternative investment space or strictly multifamily?
No, I'm focused exclusively on multifamily. I could walk you through the business plans of self-storage and mobile home parks and single families and short-term rentals. Like I've studied them all and I feel like I know them well enough. But it's not my business. It's not my main focus. So I would feel disingenuous bringing investors to the table on those deals. I've looked at a few that I'm considering investing in as a passive investor. But again, then I'm looking for someone like you or me who's a professional in that space, right? I want a professional who day in and day out, they bleed mobile home parks or self-storage. I'm not really looking for an operator who is, trading options when they're at home at night or in the morning, and then they're doing the mobile home parks, and then they're looking at an oil and gas thing, and then looking at ATM fund. I'm not looking for someone who's that spread out. I'm looking for focus, and that's what I bring. That's what I try to do is focus on multifamily because to be honest, man, multifamily is a big enough business with enough moving parts that if you want to obtain mastery, like it takes a lot of energy and time. And so that's what I've chosen. And, you know, I have money in other things in my life, but my business is multifamily.
Yeah, well, and it's kind of funny. Warren Buffett talks, or I believe it's Warren Buffett are talking about diversifying, but also there's a thought of diversifying. And Rob and I talk this all the time. It's like there's a certain level of dollars we want to have in the multifamily space before we kind of think about other, ways to place money, right? So I'm obviously, being that I have my ability to, buy a house, I will own my residence in Arizona here because it's really not that cost effective to do that. But for every outside dollar, I'm putting it in, obviously my bonuses, they're all going in multifamily because that's what I know. That's what we're operating. I have a very good insight into that. And speaking of insights into it, what are the locations that you're looking to acquire deals in? I think you're pretty agnostic, if I'm not mistaken, about, where you buy, where you like to partner on deals. But I'd love to kind of have a breakdown as to where you look, what you look for, and things of that nature.
Yeah, so our properties are in Florida and Texas, Arizona, and Iowa today. Um, the parts of Texas, the parts of Florida, I'm looking for, I like big cities that are not necessarily sexy. So like San Antonio is a great example. Huge city, growing population, tons of employment. If you're going on vacation, no one says, let's go to San Antonio. That's just not how it is. But what that gets me is a steady market that's steadily moving up. It doesn't have highs and lows. It's not a Miami, it's not San Francisco or these cool places to go visit. Look what's happened to San Francisco, right? It's taking a dive. But so property, like we have property in Jacksonville, Florida. Love Jacksonville. Bought multiple properties there. Again, it's not somewhere that people go, let's go on vacation to Jacksonville, Florida. People want to go to Orlando or Miami if you're going to Florida. But it has a huge population boom. It's got great economic drivers. It's got great employment there. And people just stick around there. They're not often leaving. It's just workforce. It's just the people that go there and they live their normal lives and they go to work every day and they come home and they pay their rent at our apartments. So we have some property in Austin, which is definitely one of those shinier cities, but that's a development play. It's a joint venture. It's not, it's not my typical multifamily deals, but we have property in Dallas, Houston. I know where you guys have a lot of properties. To me, is a little bit overwhelming. I'm still waiting to have the time where I can go and deep dive into that city, which will probably start with just cutting you guys a check and you guys, right along with what you guys do.
Well, you're in the
Um,
right place for that.
I know, right? So, but yeah, I mean, I would passively invest in deals in a lot of different markets if I could get convinced that the market makes sense. Where I'm actively investing, meaning where I am the operating partner on the general partnership side, because as you mentioned, I think people use this term like capital raiser. Like, I think I kind of graduated out of that. Like, I don't capital raise for different operators. I have strategic partnerships across the country that we've bought and sold multiple properties over the years. And now we partner up on different deals together. And so my investors come to me knowing that I'm basically like this hub with outlets to multiple different markets with key players and key partnerships in those markets. So my partnership is not trying to buy properties all over the country. Our partnership has a focus in Dallas with a great operating partner there, a focus in Jacksonville with a great operating partner there. So that way my investors, they're not trying to fly over the country to learn about these different markets. They know they can just come to me because that's what I do. So I have a couple of different partnerships. There's like five that I work with right now, and we've done this over the years. We just bought our 21st property a couple months ago. So been doing this
Congratulations.
for a bit and learned a lot along the way, from both the passive side and the active side. But my whole point was that I would passively invest with people in markets that I don't necessarily want to go be in. So if I'm going to actively be in a deal, I want it to be a place I want to enjoy going to. So I like being in Texas. I like being in Florida. I like being in Arizona. So there's places that I enjoy going. And then there's other markets like, I don't know. I don't name a whole bunch because I know there's people who love some of these markets. So, but there's places that I've been that I spend a lot of time thinking I'm going to actively invest there. And then I look around and I realize I don't want to be here, on a weekly basis. I don't want to be here often. But if someone else has a great deal there, I'm happy to invest my money if it's going to multiply there. So,
Right. No, and that makes sense. And it's kind of trusting the experts and just having kind of some core beliefs and feelings that are true to you and kind of what you look for because everyone's criteria is different. And,
mhm.
at least you're applying your practice and your dollars to work, which is great. So, speaking of kind of some elements as well, what are the elements that get you excited for a deal? Are you looking for a certain, loss to lease? Are you looking for, a value add plan? Are you looking for a distressed situation? Obviously it's going to change and pivot over time, but be curious to know what you are looking for in today's market to multiply your money as you're using it. I love that phrasing and whatnot because it's true. You're growing your capital, you're multiplying it, you're hopefully 2xing it, in a half a decade time horizon, right? But I'd be very curious to kind of hear your thoughts there, what you're looking for, and all that good stuff.
So I'll give you what I've done in the past and where I'm at now. But I started my journey in real estate, trying to diversify my types of investments. Once I focused on multifamily, I wanted to have different types of multifamily investments. I've bought properties that are cash flowing day one. I've invested in properties that are slightly distressed, they just need a little bit of value add and they start cash flowing 6 to 12 months in. And then I've invested in deals that are heavy value add that need a ton of work that have no cash flow till we sell the property and we just hit a big equity multiple. And what I've done by doing that is I've felt all of it, like viscerally felt it with my money on the line.
Yeah, I know that
A lot of
feeling.
money on the line, right? So I know what it feels like when things go right and what it feels like when things go wrong. So when an investor comes to me asking me a question about a type of deal, I know what it feels like. It's not just book knowledge. And so that's worked out for me really well over the years, I feel like, because I can speak to multiple different situations. I can look through a deal through the lens of every deal can look great in an investment summary. And it's something I tell investors all the time. It's like the investment summary is your lens with which you're looking at an opportunity to multiply your money, but it's also a sales pitch in a way from the operator trying to show you this is what we're going to go buy. The difference is that for me and a lot of people like you, it's like I'm investing my money into this as well. I'm not just selling you something like a pen and I'm going to walk away. Like this is something we're buying in a partnership. So
The
it's
five-year
different,
marriage,
but
essentially.
yeah, exactly. So over the years, I've done a lot. And one things that I've come to realize is in multifamily, the cash flow is not as strong as other asset classes. The cash flow can be 6 to 10% on a good deal, I would say. But really, what I've seen is strong is the equity multiple in the end. When you add all this value and you boost your NOI and you go apply a cap rate and you either refinance or sell the property, that's when big chunks of money come at you. And to me, that's it's something you have to understand because people think I'm going to make a lot of money along the way. But in multifamily, you can make a lot of money if you stay consistent. And that's what I've seen. So I've consistently invested each year into more and more different properties. So then every year or two, properties are going to sell. A property I bought 5 years ago, that's going to sell. Then another one's going to sell. So I constantly have a feed of properties that are selling to invest in new properties with. But if I'm looking today, I'm still looking at value add plays. I'm looking at properties that are not fully stabilized, mainly because for me, I'm still trying to grow my wealth. I feel like stabilized properties are great if you're already wealthy and you have all the money you need and you're just looking for a place to park your cash so it doesn't lose value. Then a stabilized A-class property that not a lot of work needed to it, that's a great place to put your money. But for me, and I would say a majority of the investors I meet, they're looking at real estate as a way to grow their money. And you don't grow your money by like $1,000 at a time, $500 distributions here and there. I think you grow your money when you can put money into a deal with a solid business plan behind it to really multiply the value of that property, whether it's through management play, whether it's through a property that has low occupancy, but the market is higher occupancy. There's a huge list of value add plays that you guys do a lot of these really well as well. But for me, a lot of looking at real estate, you're talking about kind of what are the things I'm looking for? There's a few lenses that I mainly look through. One, I feel like most multifamily syndications come down to where are your rents now and what are they going to be? And then what are you buying it at now, door price, and what could you sell it at? Everything else becomes like the details of how to get through those things. So one thing that I've done for many years that most investors don't do, if you're checking the rents, you have an investment summary in front of you and it says, we're going to get from $800 to $1,200. Why are we getting to $1,200? Because the properties around us are renting for $1,200. Pretty straightforward. How do we get there? Well, there's some sort of value add we have to do, right? We either have to renovate, change the management, something needs to happen. Well, I can pretty simply pick up my phone and call the properties around there and say, how much is rent there? And if they say, oh, renting for $1,100 and we're doing a $500 discount on the first month, that $1,200 doesn't look as strong. Okay, well, let me call the other property. How much are you renting yours for? Oh, renting ours for $1,050. Man, well, now I'm not so sure about this investment summary anymore, right? I'm not so sure about the business plan to get to $1,200.
It could
But
still
on the
be a
flip
good
side, of
deal,
course,
maybe. It could be a good
it,
deal, but you maybe just aren't going to hit that massive premium that you're basically alluding to in that business plan, right?
right. And it's easy enough for investors to check. That's the thing. Like investors don't want to do that extra work, but we're talking about, 30 minutes of your life making phone calls. The door price is a trickier one. Like, what are you buying it at per door, and what's it going to sell at when you're looking at projections? If we're buying it at 90 a door and we think we're going to sell it at 145 a door, it's a pretty big delta. How are we going to achieve that? That's trickier, and I've told you about this before. Like, I've made some mistakes where I thought, I don't think we're going to get to that door price. I don't think this is a good investment. And then I've been shocked that they went above and beyond. I'm friends with a lot of people in the space, so I hear how their deals do. And I applaud them when they go beyond that 145 and they're selling it for 160 a door. I'm like, well, I missed that one, but sometimes you miss, right?
Yeah.
But on the flip side, I've seen plenty of deals where they overestimate. We're going to sell it for 160 a door, and then it goes on the market for 140 a door, because they're just not hitting those numbers and they thought the market was just going to explode around them. So that's a little trickier. I think that takes a lot more time in the space and attention to the markets and seeing what's trading, what are the properties doing, or a couple of key relationships with brokers that you can simply call them and ask them what their opinion is of this deal you're considering investing in. So those are the main things I'm looking at that I can really judge. And from there, it's looking at kind of the nuances of the business plan. But it's tricky because I have a lot of insider insight because I pay attention to these markets really intimately, right? So I can look at a deal and know, oh, we're getting this for a great price because I've been tracking the properties around it, and not every passive investor is going to do that. But that's why they find people like you. Like, you do that in your markets, right? Like, that's your expertise, is to know all those things for them. So, but there's a whole list of things that passive investors could do to, get to know these deals better. But that's some of
Yeah.
the things that I look for when I'm either passive investing or actively investing.
And speaking of investing in lists, let's transition into your guide that you were telling me about and I've seen, of course, online. So can you kind of dive into, some of the key points you want to talk about there? Obviously, we want people to inbound to you to, of course, process that and download it. But if you can just kind of talk about some of the high level thoughts there, as you just did right here, that'd be really useful, I think, for the listeners here.
Sure. Yeah. I mean, I have basically a guide to passive investing, and it's 25 key points that I've put together through my years of investing in real estate, over 20 plus deals, over 2,500 apartment units worth over $300 million. And it's pretty easy to find. People can go to amitycashflow.com/guide. But what I'm trying to impress upon investors is that I think there's this take that investors are kind of beholden to whatever these operators bring them and whatever the operators will allow them to see, or how much time they're allowed to take of the operator's space, right? But I think that investors need to be a little bit more empowered to know that they're a big piece of this puzzle. For you and me, we're multifamily syndicators. We rely on investors investing with us so that we can all go out and buy larger properties with great returns. But those investors need to be comfortable, they need to be educated, they need to feel like they're a part of the process. But then at the same time, they need to be as passive as they want to be. So I put together this guide. It's 25 points. It kind of ranges over some main topics. We talk about the background of the operator, like you getting to know the operator that you're investing in before you even look at a deal with them, what you should look for in an operator, setting your expectations as an investor. So these are you discussing with the operator, here's what I'm going to be looking for out of this deal. And are we on the same page? What kind of monthly updates or quarterly updates or annual updates do you send? And if that works for you as an investor, some investors, I will tell you from experience, some investors don't open their emails from you. They don't really care. They just want to write that check and know that in the end, their money got multiplied. Great. Some investors are checking every email, they're clicking on your links, they're looking at the financials. So, how do you, as an investor, want to be throughout the lifetime of this investment? And then talk about looking at the actual investment summary. So when the operator sends you a deal to look at, just what you can be looking at and questions you could be asking and how you can digest that information and kind of through what lens. I talked a little bit about it before, where this is you being able to see the opportunity, right? Like, these are not public offerings. These are things that if you're on my investor list, you get to see this, but no one else does. And that's a really special place to be. But also understanding, like, this is a bit of a sales pitch. You need to understand that this is going to look as shiny as they can make it, right? And what questions could you ask that might uncover some things that maybe they didn't put on there, and you should know about it. I talk about the underwriting because as a passive investor, the underwriting is really the numbers, the financial version of the business plan that's presented in the investment summary. So how do you look through that? And what are some of the things that you can double check on your end to make sure that it makes sense to you, that is logical to you? Talk about man, the loan in the recent years, especially. 5 years ago, interest rates were low. Every property could qualify for loans. You could get high leverage. You don't have to put a lot of money down. The loans made easy and quick sense. You could, find any property and any of the majority of the loans would work for it and you're going to make money. But today, interest rates have normalized. They're higher now. I say normalized because people think that they've skyrocketed, but if you look at the
No, they're
historical
they're
evidence,
they're
they're just
historically pretty
normal.
awesome. Yeah.
Yeah, they're just normal, decent interest rates. But it feels painful because they've been so dramatically low recently. But the lender is the hugest financial partner in this deal, right? Like they invest millions and millions and millions of their dollars. So you need to understand the strength of that loan. You need to understand the nuances of that loan. You need to understand the terms of that loan. And I think a lot of investors glaze over that part. And I think today you can't afford to do that because that's where deals oftentimes are going south, especially today where it's 2024 when we're recording this. And some deals are not doing well. And a majority of it has to do with the loan that they took out or poor operations. But so understanding the loan, and then really after you buy the property, on my list to close out with what do you expect once you buy the property as a passive investor? What can you do? What can you do to track your investment? What should you be tracking? Some key numbers you can be looking at, and really a way for you to feel like a part of the process without feeling like you have to run the process, because that's why people want to be passive investors, right? Like, I don't want to do the work. But look, if you invest $100,000 or $500,000 in a deal, I would advise that you should be paying attention to it once a month. Look at your numbers, ask some questions, empower your investors to, like, if things don't look right, ask some hard questions. But what do you look at? You got to be able to look at the financials and know if something's questionable, right? If you never look at it and you're just overwhelmed by a T12 financial statement, then yeah, you might as well not look. But so that's kind of what I put together this list. It's pretty easy to find. It's amitycashflow.com/guide, and you can download it for free there. So
I love that.
that's the
Well,
guide that I put together, and it's really helpful. I think it's like I said, it's based on my experience as both a passive investor and as an active investor, a general partner, and things that I've seen go right and things that I've seen go wrong. Because as you know, man, it's like you got to be able to assess risk as much as you have the ability to see the opportunities. And you can't be scared off by the risk, but you can't be blinded by the opportunities. And I think, that middle ground is where you have to be educated to find yourself. And that's how I think you have success in this industry.
I really love everything you said there. And, speaking of debt and equity, it's not going to determine if you're going to hit a grand slam or not, but it will determine how much money you could lose in a deal because the debt and equity is directly correlated to that. Specifically the debt component to it. If you're over levered, that's going to be challenging. If you've got, fixed or if you've got variable rate debt, you've got shorter term bridge, well, that can be fine. Obviously, those who, took out, that kind of structure in 2021 and 2022 may be challenging right now, depending on what's going on. But, I would certainly say those are two factors that they're not going to determine if you hit a grand slam, but it will determine if you lose your money, I would certainly say. And then the other thing you really hit on too, just to kind of call back here, just on pamphlets, sexy marketing. The reality of this business is that there's no free lunch and there are very few deals that actually aren't being marketed. I mean, I know if you get into sub 50 unit space, you can certainly see that. But generally speaking, if you're getting institutional deals and you're seeing, IRRs that are call it north of a 22, you should be very concerned about what's going on there on projections. That's not to say it can't exceed that, but just realize that the person who bins these properties typically is paying the most, and it's really not that easy to make money, unfortunately, especially in the competitive space we're in right now. So I would just kind of have a buyer beware that if you're seeing returns looking too sexy, too great, and that are so much larger than the next operator that you're talking to, you should probably have a little bit of a red flag going off in your head. Have you seen that before in your experiences?
I mean, we've sold deals to people like that I'm seeing their marketing materials to their investors, but I know what they're buying a property at from us.
That's
I'm
already
like,
been
man,
value added. Yeah.
I mean, we did the value add and we just made a ton of money off this. Like, you know what I mean? We just made our investors a lot of money. And I'm not going to say numbers on here, but and I know they're buying it. I'm like, what are you telling your investors? And you know, it's a small space. You and I could get the offering materials from a deal like that. And I'm looking at it going, man, I don't know where you're going to find these numbers, but okay, good job.
I hope
And I
that
think
happens
that,
because the economy's in a good place if that happens.
yeah, I mean, but I think you know, your point is like you should be healthily skeptical as an investor of any investment. And I think that's one of the reasons like so I talk to a lot of new investors on a daily basis, and I try to cover it every time in the first call. It's like, let's talk about the risks of this. Just going in, like, let's all be aware there are risks to investing by definition, right? If it's an investment, there are risks. What are the risks of investing in multifamily? And if we don't cover it, I send them a video and a text breakdown. Here's all the risks of it. Like, know what you're getting into because it's a lot of money. This is money that you've earned with your family in mind and your future in mind, your retirement in mind, right? And we don't deal in $5,000 and $10,000 here, right? These are large properties with a lot of money invested on the line. So people should know what they're getting invested in. They should know what the risks are. Debt and equity, to your point, I mean, it can change deals dramatically. And one thing I think that people should understand about loans, and I spoke about this at a meetup recently, someone asked me, they kind of had this idea that bridge debt, you know, so bridge debt is bad now, right? I'm like, well, it's
No,
not
bridge debt's
bad or
actually
good.
arguably good now because
Bridge
it's
debt,
shorter. Yeah.
it's short term, but the thing is, all debt, it's a tool. Like, what is your plan? What tool do you need to do that? You know, if I buy a property that's 75% occupied, my plan is not to keep it at 75% occupied, but I cannot use the tool of agency debt in a 75% occupied property. I have to get some kind of bridge loan. So that doesn't mean the deal's bad because I can see the runway ahead of us that if we get to 90, 95% occupancy, we're going to crush that deal. And I see a very clear path to that with properties all around us. Like we bought a property in Dallas, and all the properties around us are full with one or two units empty, maybe. Rent's way higher than ours. And our property is in the 70% occupancy. Yeah, I'm going to use bridge debt because I'm going to get to that. I can look around and see the writing on the wall that we have a clear plan in place to get to there. Yeah, I can't get agency debt. That's just not a tool at my disposal. So it was good to kind of explain to this investor like there's not a black or white that's good or bad. You just need to know what the loan works, how it works, and why it works for your property. And that's really important. And if you don't understand the loan terms, ask the operator, ask to be explained to you. Because if you don't, I think that's one of those things. If you don't understand the loan, don't just sign off your, you know, send your money off and go, well, I'm sure they have it figured out. You know, I think it's worth it today to understand those things and spend some extra time to get to know those finer points of the deal.
I really love that. And it's funny, I think we all can avoid recency bias in one way or another. This has been a fabulous show. Chris, where can people find you? Where can they see your amazing content? Where can they learn about you, reach out to you, and hopefully invest with you?
Yeah, I appreciate it. It's been a great conversation, and I appreciate that you guys put out such high quality material. And I'm honored to feel like I can be a part of that on your podcast. I mean, I've told you this offline too, and I hope it's not lip service. Like Lone Star, you guys do great. You do great product across the board. So I know your podcast is one of those. I'm pretty easy to find. My website is Amity Cashflow, AM is in Mary, Amity Cashflow.com. And then I'm everywhere on social media at Amity Chris Collins. So on all the different social platforms, whatever you prefer, I'm pretty easy to find there. On my website, if you're looking to get in touch, there's a contact tab, amitycashflow.com/contact, and book a call and we can talk through what you're looking for in an investment or just questions you have or just want to learn more about the business or my company or what I do.
Amazing. Well, thank you so much for being on the show. To everyone listening this week, we really appreciate it, and we'll catch you next week. Peace.